Okay, so what we're going to go through here is the basically the big ideas for 2026. So we're going to it's all big today. It's the big picture, starting off with the macro outlook, the big levers, so the asset allocation views, big ideas, so particular assets and market that look of particular interest going into well right now, but also going into next year. Some big surprises. What's the best or worst that could happen? And then a bit of a look at the risks and, of course, a bit of Q&A after that. So just in case you aren't familiar with me or what I'm up to here, so I started Top-Down Charts back in 2016 to be a multi-asset research service. The aim of the service is really to serve as a valued resource and trusted resource for portfolio managers, investment advisors, and really to try and help make their job easier. I come from the background of investment management, so I kind of quite, closely understand, you know, what they need and design the service on that front, and ultimately to help investors make decisions with confidence. And, that's really what everything in this presentation is aimed at. So starting off, diving straight into the big picture, the key theme here is that of re-acceleration. And so if we look at the last few years, certainly on the PMIs, at least if you measure it by the manufacturing PMIs, it has been for a sort of period of stagnation at the global level, at the aggregate level. Growth has kind of ticked along, but I think we all know that there are some weak spots, both now and previously within and across economies. And so the idea here is that we're coming out of that period of stagnation. We already had central banks moving into easing mode last year across the world. And then, of course, with the tariff, trade war issues carrying on this year, we've had extra waves of precautionary easing. And so that's really taken monetary policy from what was a headwind, into 2022 to now a significant tailwind. And so, really, the key thing here is that we get this as a result of all those monetary tailwinds, fiscal stimulus, just a natural sort of flow through out of that slowdown that we're heading into a stronger period of growth into next year. Now, obviously, the next step from that, and it probably is, a couple of steps ahead, but we need to start thinking about it now, is the idea of resurgence. So if you get a really powerful growth reacceleration, then the natural consequence or accompanying feature of that is resurgence of inflation. So if we look at the global median inflation rate, so the global inflation pulse there, it's already turning up again. So, it's definitely settling into a new higher range. Capacity is still tight on a number of measures. And the cycle, again, as I noted, was on the up. And inflation expectations are still pretty high and sensitivity to inflation. And I think that's a really important part of this too. And that's why, you quite often actually see kind of two waves of inflation across countries and time, because people, as soon as because we're still carrying the scars and shock of the shock of 2021, 22, any uptick in inflation is going to just flow through the system, and sort of compound. And add on to that, the commodity outlook is pretty bullish, and I'll talk a bit more about that shortly as well. So best guess is inflation goes up in 26. Now, against that, there are some things trending in the wrong direction. For example, the US unemployment rate there, well, who knows what it is at the moment, but it's at least trending in the wrong direction. Same thing if you kind of cross-check that against the small business and consumer surveys. Their perspective of the labour market conditions has been that things have been getting at least less hot. It was like really tight and hot there, but things have been sort of cooling off there. So the direction is definitely something that we pay attention to. Level wise, it's not really in alarm bell territory. Even with the unemployment rate ticking up, that's still pretty low in the scheme of things. The real concern here, though, is that things can change pretty quickly. And if you look at these spikes in the unemployment rate, they tended to turn the corner pretty fast. So that is the concern, and that's a reason to kind of keep tabs on this as a sort of counter to the base case, and really the bulk of evidence. around the reacceleration theme there. But that brings us to how do you kind of think of this all together on the big picture view? We call it the macro risk sandwich. So on each side, one side is the resurgence risk, and then on the other side is the recession risk. And then, you've got the middle porridge to throw another piece of food label into there. And that's just that, not too hot, not too cold, which is entirely possible. But in terms of what each pathway means, the resurgence pathway, that's where commodities do good. Traditional cyclicals, global equities, and rotation, middle ground is probably more of the same. So tech bubbles on, and all the things that are kind of been working probably continue to work. Whereas recession, it's definitely more to the defensive side. And I think one key market to really keep tabs on, aside from all the data, is just industrial metals here. If you sort of snip off, and again, you know, going back to that idea of that we're actually seeing evidence of this. Um, if you look at the industrial metals here, if you snip off that April bit there, it's clearly in an uptrend, and making an attempt at breaking out there. But in terms of all these sort of competing forces there, brings us to the asset allocation picture here. So the big levers. And the main thing to get right on allocations is the stock allocation, really, ultimately, because that's the thing that has the biggest driver of both risk and return for most portfolios. And so the problem there is that stocks are, by most measures, and certainly US stocks and US tech in particular, very expensive, and investors in the aggregate are running very high allocations. And and then if you look at these valuation indicators here, it's both problematic and good in a way because of how it ties into what we're talking about there. If you look at US market there, expensive, gold expensive, those are the things that are basically the favorites or the most popular things at the moment. The things out of favor, treasuries and commodities, those are the ones that will actually benefit under the two extremes of the macro risk sandwich. So, you know, treasuries will do well in a deflationary recession. Commodities will do well in an inflation resurgence environment. And so that kind of does give us a bit of clues as to, you know, where to kind of start leaning towards as these scenarios come into play. But also, if you kind of just step back and think about it for a second, from an asset allocation standpoint, one of the big things, aside from trying to get good returns, is to actually protect capital. And on the defense side of things, if we're looking at the treasuries and commodities, they're basically protecting against the two key risks. So you might say, well, actually, you can sort of start building up exposure to actually both of them because, um, one, the inflation resurgence commodity bull might come on faster than we expect. And two, the recession side of things might come out of left field and also kind of just happen faster than we can react. So that's a sort of argument for the whole, barbell of dual defense there. But getting more into sort of the practical element of it here, the stock bond ratio is kind of one of the key measures there for or almost the key sort of synthetic price for asset allocators to keep in mind. And if we look at stocks, as I noted, expensive, bonds cheap, stocks expensive versus bonds. So that already should be making us think about when is the time to move from stocks to bonds. We can see that we've had a really extended run there, and the relative value indicator is definitely in the expensive territory. But practically speaking, if you want to see that, well, if you're preparing for that black line in the chart on the left to go down, the chart on the right kind of gives you the answer. So the blue line on the chart on the right is the unemployment rate inverted. And so the most reliable or the most sustainable drawdowns in the stock bond ratio is when the unemployment rate is heading down or heading up down in that chart. And so really the key driver there again is recession, and hence why you look at bonds as the recession hedge. As for bonds by themselves, Treasuries are basically undervalued, unloved, and underestimated because, I think there's still this sort of thinking around the market where, okay, can we still trust bonds to do the defensive role in the portfolio given what happened in 2022? But I think it's important just to momentarily reflect on that is that 2021, 2020 treasuries were really expensive. And so, going back to the idea of which one do you go for a defense, just to skip forward one, actually, if you look at gold and treasuries, and you think about gold as basically an alternative defensive to bonds, you want your defensive asset to be a dampener and protector of risk against risk, not a source of volatility. And so when treasuries were expensive like that, you you couldn't actually be confident that they would actually perform their role because, when an asset's expensive, the more likely outcome in the next, months, years is actually that it becomes a source of risk. And so thinking about gold and treasuries, and this will be probably the most contrarian or unpopular thing to say, is that treasuries actually look better than gold to do the defensive role at the moment. And this is why one thing that I've sort of been going on about with when you think about bonds and gold as the defensive side of things is that two principles is one, diversify the diversifiers. So some gold, some bonds, because sometimes you have different market regimes that favor one more than the other. Diversify dynamically is the other one. So sometimes more gold and sometimes more bonds. And I would say that this is the time for more bonds rather than gold, at least on the defensive side. And at least with regards to defending against, traditional recessionary downturn, a recession where it's, a deflationary recession rather than a stagflationary recession where inflation's also going up. Because gold also kind of, yes, it can do well in those environments, but gold also is a kind of a hedge against things like geopolitics, devaluation, debasement, that sort of carry on. And then also just monetary easing, helps gold a lot of the time. But if we just also look there at the blue line on the chart on the right, we can see that gold has had this extended, stretched period of performance versus bonds there. So might be a bit of time for a rotation there. And then lastly, before we move on, is if we look at this bond allocation chart, it's one of my new favorite charts here on the right there, and it's showing using three different sources so we can have greater confidence that it is telling us an accurate picture. And it's the allocation that investors have in the aggregate to bonds. And yeah, it's very low. So that's this is your classic contrarian setup where the asset is looking cheap and allocations are very low. Of course, you can't just be contrarian for the sake of contrarian. What bonds need to actually perform from here is, falling inflation, falling growth ultimately. But the other thing there is just if we look at where we last visited these sort of levels was one, at the peak of the dot-com bubble, and then two just before all that stuff in 08, 09 kicked off. So it's also, a bit of a sign of the times in terms of where we are in the cycle. And, yeah, again, a criterion risk indicator there. But moving on, so that's kind of for the bad parts. If we get this fabled growth reacceleration, things turn up and boom times come in 2026, commodities are going to do well. Now, if commodities do too well, again, that's where you run into the situation where the stock commodity ratio. So we looked at the stock bond ratio there, which is probably more familiar to most people, but the stock commodity ratio there, well, we can see there that it's had a pretty good run, but we also see, and importantly, we had this period around 22 where that significantly fell. And so that's basically a situation where commodities were outperforming stocks and basically performing a diversification role. So back in 22, just to also dwell on that for a second, back in 22, we had there Yeah, gold was also expensive. So stocks, treasuries, gold, all expensive, commodities cheap. And so, that's where, there's a lot of criticism about valuations these days, but that's where those signals can actually become very useful. So if you'd been paying attention to that, that would have at least given you some clues to what was about to unfold in markets there. But yeah, again, similar to the stock bond ratio there, stocks are expensive versus commodities. And yeah, all this monetary easing that I talked about before is likely to put a strong tailwind behind commodities there. So we've got on the chart on the right there, the black line is annual change in commodity prices, and the red line there is basically how many central banks around the world are in easing mode. And so, yeah, I've seen this big shift to easing tailwind for commodities. And so, yeah, moving into commodities by themselves. And so when I talk about commodities here, I'm talking about the asset class view here. So, a diversified basket of commodities. And yeah, as I noted, commodities are cheap, turning up from a cyclical bear here. So we had that big big bounce back from 2020 crash, and a big part of that was the reopening, but also all that stimulus that we had back then. And then of course that blow off spike there was the Ukraine invasion, aftermath of that. And then we've had this sort of cyclical bear market at the moment that we're now starting to come out of. Breadth has also just been in a bit of a wash, but starting to trend up a bit and turning up at the moment. And that's all set against, this global economic rebound story, and also a lot of thematic demand drivers that are really starting to come online now. And then also you put that against the fact that there's been about a decade of underinvestment in supply. And so that's actually more significant than, we did see a bit of a slowdown in commodity investment just prior to the start of that big super cycle in the 2000s. But this one's just on a different scale, and part of that's just digesting all that overinvestment that occurred. But now it's left us in a position where basically the supply tailwinds because, and on top of that, the sort of ESG movement has kind of um, starved the sector of capital a little bit. And then also sentiment's fairly muted on commodities. So I think that, a big upturn in commodity prices would actually be something that would take a lot of people by surprise. And then if we look at commodity equities, so this is equal weighted global commodity equity basket here. So industrial metal producers, precious metal miners, oil and gas, and then agri related. And we can see they've actually already broken out with pretty good red there as well. And then also if we look at, back to the commodity price picture there, um, the equities have actually led the prices in a few instances. And you might actually kind of expect that because, people who the type of people investing in commodity equities are probably keeping pretty close eye on the prices, and they probably have a pretty strong view on the commodity prices as well. So yeah, another sort of vote in favor of that key theme there. But the other sort of big levers is the whole, US versus global. You know, the sort of pushback on this kind of thing is that, yeah, US has been more expensive than rest of the world for basically all of the last decade. But the thing is now it's starting to get basically pretty extreme. But the other thing is that the rest of the world is actually after you know after all kind of dealing with their own problems, like emerging markets kind of had this long period of consolidation following the big boom of the 2000s. Developed markets, obviously with Europe, you had the various rolling crises. And so we're kind of at the point now where all of that's sort of behind us and it's kind of put us in a good place. But just looking at the way that valuations are turning up across the rest of the world is a pretty positive sign. But the other thing is, if you look at US versus global price performance, relative performance, that's actually already peaked. So it's actually, yes, we can debate about what the next steps are, but it's actually already turned the corner there. The other key factor there, though, amongst all that, is the red line because the red line is ultimately what's reinforcing the relative performance in price is relative performance in earnings. So you do actually need, rest of the world earnings to actually step up. And, the interesting thing on that is if you think about back to the initial, prognostications on the macro front, if you get this global economic upturn, uptick in commodity prices, you know, tailwind for traditional cyclical equities, rest of the world is actually much more skewed to those sectors, and US is actually very light, way lighter than usual to those sectors, and very much heavy on tech. And meanwhile, tech probably is actually not going to do so well. Maybe it just plateaus. In the best case, if you get, inflation resurgence, which kind of puts upward pressure on interest rates, that could put a bit of the brakes on the tech side of things. So from a fundamental macro standpoint, that's how, you can get a bit more follow through in that. But just on global or rest of world equities by themselves, yeah, the technicals look great there. It's broken out again after a long period of consolidation, strong breadth, and significant monetary tailwinds as well. You can see that a big driver of that has been that monetary easing. Also, tied in with that is a bearish outlook on the US dollar. So that's another big part of things. I was going to talk about that last, but yeah, if I look at the US dollar, it has all the hallmarks of an asset or a market that's moving from bull market to bear market. And so, a weaker dollar actually helps with that as well. And again, going into the macro fundamental side of things, if you do get stronger global growth after this sort of period of stagnation, then that's something that actually adds fundamental support to that sort of technical assessment. But digging now into the big ideas and natural flow on from that really is, well, first stop is Europe, finally broken out to new highs. Cheap on a relative basis, definitely, and strong monetary tailwinds. And then also sentiment's still quite pessimistic. You do have the sort of geopolitics overhanging, which could be potentially a good thing if they manage to find peace in Ukraine. And then also at the tail, so got to acknowledge that the tail risk is that thing spills over to a larger conflict, which certainly a concern. Japan is another one, and the interesting thing about these Europe and Japan is, if you try to say a bullish story about those, I think probably most people's immediate reaction is to list off all the well-known negative and bad things about those places. Like, for example, Europe with all its overregulation, etc. Japan with the demographic side of things, but. Japan, we've actually seen quite a significant shift there. Yes, the breakout in the equities is very interesting and important, and it's an extension of the existing uptrend. But we've also seen a breakout in the nominal GDP, and I can hear people probably shouting at me, "Yo, you can't do technical analysis of macroeconomic things." But the point there is just to remark that GDP, nominal GDP went sideways for you know, basically 3 decades, and then now it's on the up. It's out of that range, and that reflects quite a few things. But along with that, you've had quite a few changes on the equity front that are actually quite helpful. So corporate governance definitely improving, profitability's gone up a lot of share buybacks as well. So these are things that have been kind of years in the making, kind of an echo of Abenomics. May he rest in peace. And another thing there too on the demographic front is we've actually seen female labour force participation go up significantly and elderly. So people are, more people are working and more people are working longer. And at least in the immediate term, that actually has somewhat of an offsetting factor to the otherwise bad demographics. But again, just go back to price. Price is looking good there. And actually also just to round out their allocations to Japanese equities very low. It's not really something that a lot of people are looking at or thinking about. Emerging markets, another very interesting one where I would say also that there has been kind of like a ongoing doubt or pessimism or skepticism around EM because we've had many false starts there. And certainly, if you look at this equal weighted index of emerging market equities, excluding China and in US dollars, over the last really, what's that, 15 years, it's gone, it's never left that range really. And so a long-term range trade has, it's quite demoralizing for people that, have grown used to or want to see markets that just trend up over time. But so, that demoralization is kind of seen in the valuations there, very, very low versus where they had been in the past. And that's the kind of thing that sets up psychologically for that kind of breakout. But then also fundamentally, the reason why it has been sideways is that there has been that kind of digestion of that all those sort of economic excesses, and there has actually been positive changes there. But also, I think if we just zoom out and again look at the what price is telling us here on a relative basis, again, emerging markets are actually turning the corner of again versus US equities there. So that's definitely, and that comes after a long-term relative bear market. So very interesting chart there. Whenever you start to see turning points after such a extended, significant, and prolonged move, that's the kind of thing that you got to pay particular attention to. And also just in absolute terms, again, starting to break out after that long period of consolidation. China, yes, it's a big part of the EM story, but it's also a story in of itself. And it's not the only story for EM too, as we kind of saw there, the fact that EM equities, you know, equal weighted, excluding China breaking out, it's not the only part of the story there. So yeah, I think that kind of says it all. China's cheap, breaking out, and completely underestimated. Again, it's very similar to the same themes of the previous couple of points there about basically the narrative being worn out and expired. So, there was this understanding of, China's in decline, it's in a slowdown, they can only copy, blah, 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 the pollution. And then, if you look at things have actually changed very significantly over the last decade. So pollution's kind of come under control. We've seen mass adoption of electric vehicles, massive rollout of clean energy, but also traditional energy, like the build out of nuclear is still significant there. And probably most important is just going from follower to leader on technology. So, we're starting to get into an interesting phase of history now where the breakthroughs in technology are actually starting to come out of China rather than being copied there. And the deep seek moment is kind of that shot across the bow there. It's a shot across the bow in terms of the leadership of US big tech. Because if you think about Chinese tech, they've got a massive market in their own right, but also maybe they have an upper hand on, penetrating into what you call the global south, the markets that are kind of less friendly to US, more friendly to, BRICS, China, etc. So it's, I think just, you know, it's worth always kind of rethinking and making sure that those, old stories and narratives that you have not become, out of date and, just consensus. But if setting all that aside, key valuations turning up, if we ignore what the country's called, and to see that technical breakout, it looks good. Another interesting area there, both on the technicals and the thematics, is global renewable energy equities there. So you had this big boom there and then bust, and then now we've got a breakout into boom again. Um, you know, and I think with the thematics underway there in terms of the energy transition, the rising popularity of clean energy or renewable energy, and then also the rise of electronic vehicles, and also maybe at the edges the AI electricity demands. It's all fairly clear that there's significant thematic tailwinds there. And copper is kind of an echo of that as well. Again, the if you think about this big ambitions about the energy transition, mass adoption of electronic vehicles, a robotics revolution, commercial space sector, there's a lot of big things that are already starting to happen that are going to need a lot of metal, and copper is a key metal, especially on the electrical front. And again, just haven't been investing enough in supply, and I think it's going to become very apparent in the months and years to come that the amount of metal available is not going to match up with the amount of demand there, and we're already seeing their prices the mediating factor there, and we're already starting to see it break out. So but this one is kind of unloved and underestimated. There's a couple in this category. So the previous ones were all breakouts. This one is definitely not a breakout. It's a sideways. Maybe it's a breakout in the weighting. Yeah, so energy sector equities have been basically dead money. Energy prices have been languishing, quite hated. Very different picture to renewable energy, and the whole sort of social governance shifts that we're seeing across a lot of investor cohorts where there has been pressure to actually decarbonize portfolios, they call it. So a lot of headwinds there, aside from just, energy prices, which crude oil is also one of the unloved and underestimated ones there. And you can see that, the prices there have been stagnant to down. But it's when these are the kind of places where interesting opportunities are hiding, perhaps, or getting ready in the wait. And yeah, just to show that it's that much hated. If you look at implied allocations to energy sector, it's at record lows and only looks to be trending lower. And yeah, on the crude oil front, it's hard to find a crude oil bull these days. And maybe crude oil is in long-term decline with all those, energy transition, all the rest of it. But that's not going to happen overnight. That's a long-term thing, and cycles are still going to be a reality through any transition as and when it happens. And yeah, again, if you look at gold there, gold is kind of the opposite of crude oil. It's looking very stretched against the rest of commodities, whereas oil is looking, cheap, I guess you can call it, versus the rest of commodities, very much extreme to the downside. And so again, yeah, that's it's where those rubber bands are kind of pulling and eventually snapping, where some pretty good opportunities can be found. There's probably a few, in terms of catalysts there. There's geopolitics maybe having an influence on that. You know, the Venezuela question mark that's being raised with all that military build-up there. Maybe it has a short-term blip on oil, but then, there is this argument there that, okay, well, if they actually get regime change, then that could see Venezuela production coming up, and eventually, it takes a while, and that could actually put more downward pressure on. But, even just going back to the starting themes that we're talking about, a global economic upturn, you know, energy or oil production or oil consumption rather is still cyclically sensitive. You know, it's when economic activity picks up, hard real economic activity picks up, that the demand increases. So that's one way that you can get there. The other one is REITs, REITs and commercial real estate there. We've seen a radical relative underperformance there. That's again, it's as I said before, when you got to look at these markets where there's been a significant, substantial, prolonged period of movement in one direction or the other, and then looking for any signs of a change there, which there are not at the moment. Again, in contrast to the previous ideas. But one thing there, if you look at commercial property prices in CPI adjusted terms, so we're already down almost 30% there, which, that's not far off the 35 and 40% that we saw during the more prolonged downturn in the 90s and the crash in 08, 09. So, it's already seen a pretty significant adjustment. And again, this is REITs, real estate are another one of those really hated asset classes, and but we still need a catalyst, and that's maybe a situation where you get a benign lower yield environment. So you can get a lower yield environment where everything goes to crap and economy crashes, but sentiment's not going to be good, and real estate's probably going to still come under pressure. It's an environment where you have a slowdown and a sort of a more friendlier drop in yields that could be supportive there. And in that sense, they can almost be thought of as a defensive against a sort of mild slowdown. Moving into big surprises, um, well, probably a lot of these won't be surprising because they're basically almost a base case to what I've been talking about, which I think in many spots are kind of out of consensus. So, it would surprise those who aren't thinking about these. So on the good side would be global economic reacceleration, a bullish rotation. On the Fed front, maybe the Fed goes hard on easing. Maybe they change their interpretations a bit, and you see return to QE and more rate cuts, boost growth assets, or fiscal stimulus. You get that whole the $2,000 check that Trump's been tweeting about, or and that ignites another retail speculation frenzy. But of course, those two things will also lead into probably an inflation flare-up. And yeah, that's basically my base case is higher inflation. The magnitude, though, is uncertain. So, a mild uptick in inflation, like a sort of controlled burn, is probably manageable for markets. And it's going to be supportive of the those things that benefit from that. That maybe does less damage to rate sensitives like REITs and tech stocks, etc. But yeah, if that happens in a disruptive wildfire fashion, then obviously it's a different thing. You get a bond yield surge, 2022 style echo. Geopolitical hotspots, that's obviously an ongoing issue. There is a whole number of potentials there, and I think you know, it's kind of hard to, it's quite an interesting topic, but it's hard to really do much about it because there's always geopolitical boogeymen hiding around the corner, and you know, the sort of meme or common perspective on it is that, oh well, you only get a short sell-off and then things recover pretty quickly. 2022 kind of threw that interpretation into disarray a bit. So yes, things rebounded, but it was basically, the Ukraine invasion was a catalyst to commodities doing well, bonds and stocks selling off. But that's a key point there is that there, as I said before, there was already fairly clear clues that both bonds and stocks were at risk, whereas commodities had upside. And so that's, to me, how you navigate geopolitics is that, yeah, mostly ignore it. But when it sort of aligns with an existing case, that's when you can actually do something about it. Or, because, yeah, if you were looking at that valuation setup, you would have said, okay, well, maybe we start moving in that direction. And then, of course, the geopolitical tail risk happened, and it was the catalyst to actually movement on both of those things. Then US recession, that is, yeah, I would say pretty much one of the bigger risks there. And then there's two ways that unfolds. One is where you get global going it alone, which I think is possible. And then the other one is where global falls as well, which is obviously bad. And that brings about the, focus on defenses, tech bubble burst or valuation mean reversion. When you talk about things like that, or credit stress, private credit, all those kind of things, it's probably not gonna just happen by itself. You probably need something to kind of trigger it off, and most of the time, that is an economic recession. You know, like for credit, for example, if you say, well, and by the way, I think there is risks in private credit, but that's not gonna just come out of left field for no reason. Private credit risks is going to come up because the economy goes down and all those weak spots get exposed, and that's where things just kind of go bad and blow up anyway. So, but yeah, as I'll talk about in the next slide, actually, there is a reason to be focused on that risk. Um, on the mixed front, US dollar bear market gathers pace. Yeah, I think that that's actually pretty good likelihood. And it's mixed because, well, um, if you're bullish on the US dollar, that's bad. Or if if all your assets are in US dollar and you're not, positioned to take advantage of US dollar weakness or predicting against US dollar weakness, then that's probably bad. But otherwise, a weaker US dollar is actually kind of good for a lot of things. China stimulus, I put that under mixed as well because, you know, if China does step up its stimulus, then that creates a set of good opportunities within China and for things linked to China, but it also probably boosts commodities and inflation. And then in the weird section, we've also, well, aside from, natural disasters and all the rest of it, and there's things like an AGI breakthrough, which kind of, or contact with NHI, as they call them these days, results in some kind of massive technological leap, disruptions, quantum leap. I think, there are a lot of interesting and weird things on the technological front, like the rise of robotics, where you know, it's almost a common thing to see companies releasing humanoid robots these days. Like, the other one was the China again, actually on the tech front, Xpeng, which released their well, revealed their robot, and yeah, if you get mass rapid and widespread rollout of those, maybe it impacts on the way people work. But those are the kind of things where it's probably not going to happen within 2026. It's the kind of thing that moves slowly at first and then all of a sudden. So, but yeah, I guess just another thing to say, there's other things off that list. Um, but other thing on the big risks front is yeah, okay, it's not .com. It's not the .com bubble because, it's got earnings, it's different this time. It is different this time on many fronts, but then if we look at the relative valuations here, or TMT relative valuations, they're not far from where we got to at the peak of the .com bubble there. And then you look at defensives as well, they're basically as cheap as where we got to in the peak. Uh, yeah, so that's it's looking a lot like .com, and that's again that's the rubber band stretching, and yeah, that's actually didn't talk about it, but defensives, and so what I'm talking about there is utilities, healthcare, staples on a relative basis, are probably going to be a good place to hide, and when or if tech comes unstuck. But again, though, yeah, just to kind of pause on that. If you think about, it's not .com also because US tech didn't go up as rapidly. It's kind of been, a procession of things there. Maybe the last phase there is a bit more similar. But yeah, overall, that's probably the number one risk. And it's probably the most well-known risk as well, frankly. And then the other one here would be the US exceptionalism bubble, which you could call it. So if you think about this here, the blue line is an average of the valuation indicators for US stocks, US credit spreads, US dollar, and US housing. And yeah, they're all expensive. They're huge contrast to '09. And so, it's been a golden decade and a half there since the bottom. And, that just goes to show as well that uh, you have a much easier and better time starting from a place down there than you do starting from a place like up here just before the crisis or up there at the peak of the dot com. And so yeah, we are late in it. Things are stretched. We've got all these pressures building up. And yet things keep moving higher. So that's kind of the pushback, or yeah, valuations don't matter. They only matter in the long term. But I think they can actually matter massively in the short term when things actually start to turn. So and when they start to turn, they can go further and faster than you expect. So hence why I was all belaboring all those points about diversification, defense back in the asset allocation section. So definitely some food for thought there. And yeah, just finally, one scenario on the US dollar is that maybe you get a US recession, maybe global growth hangs in there and does decent. Maybe US asset prices fall, you get rotation out of US into global. That past flows loop. So one of the things supporting both US dollar and US stocks was, you know, tech, US stocks, particularly tech, goes up. That triggers more flows into US. That bids up the US dollar. That actually bids up, boost returns for foreign investors, and that triggers more flows in, and you kind of get this virtuous flow loop that has been supporting both US assets and US dollar. If that if you kind of mess with that or make it go in reverse, that could see quite a rapid decline in both US dollar and US assets. So that's, I would say, where the pressures are and the big risks. And that is pretty much that. So yeah, we'll get into question time now. I think that you can either put the question in the chat or there's a Q&A, raise your hand thing. Just quickly while you think of some questions, I'll give you a little bit of time to think of some questions. I'll go through quickly what specifically I'm doing at Top-Down Charts. So the different services, the main one is the Top-Down Charts Professional. That's the institutional one. Yeah, so that's for multi-asset investors, asset allocators, fund managers who require top-down input, provides actionable ideas, risk management alerts, meaningful macro insights. So only talk about macro as it pertains to actually forming an investment conclusion. Original research and charts to use. Yep, you've seen a good example of those charts. And that consists of a market monitor, a weekly ideas pack, monthly asset allocators handbook, quarterly pack. And then I've got the entry level version of that, which is basically a lighter version, just the key points, cheaper price point. And the other one, big one, is the weekly chart storm. It's a focus piece on US markets, 10 charts plus a portfolio strategy section, commentary, conclusions. Good way to stay on top of things, on top of the markets. And then if you're interested in gold, precious metals, miners, I've got the gold market chart book there. I'll send some links out to those afterwards. You kind of had a good taster of what I'm doing there with this presentation. So we've got some questions coming through now. Let's have a look.